Let me welcome in Mohamed A El-Erian. He's one of the world's most renowned economic commentators. We have been tracking his views since the pandemic first hit. He, in fact, correctly predicted that coronavirus selling would lead the markets to touch bear market territory. Mohamed, thanks so much for joining us today. It's interesting to have you at a juncture where we've actually now seen the markets see a marvelous turnaround, one that's left most people agape. So, how do you really rationalize that? The kind of spectacular move that we've seen, a recovery of the lows we saw as recently as March.
As you say, it has been a remarkable recovery and one that has surprised many people and one that has really disconnected from realities about economic and corporate prospects. And I think there's two reasons for that. One is the market has embraced the V-shaped recovery, and it has talked itself into looking through the inevitable short-term difficulties facing both the economies and companies. But it has also stumbled into another very supportive narrative, which is what I call the win-win. It doesn't matter if you're wrong on the V, because central banks in the advanced economies will bail you out. And that is because central banks and the Federal Reserve in particular has done things in scale and scope that were unthinkable, including buying high-yield bonds. So the market has this win-win mentality, and that has driven us much higher than anybody anticipated and decoupled us completely from the underlying fundamentals.
So you've actually said that the markets are now pretty much holding the Fed hostage, so to speak. What is the kind of ramification we're looking at here, and how soon do you see that happening? I mean, is this a situation that's going to unravel a quarter, a couple of quarters from now? Are we looking at much further, longer term impact? Because in the moment, markets are definitely on their own high.
They are, and every time we get a somewhat of a correction, it tends to be a sharp one, which shows you that there is really a very big gap between valuations and what can be validated by fundamentals. Look, the Fed and most central banks do not want financial instability to cross-contaminate the real economy. So they will do whatever it takes to try and repress financial volatility. And they have done, and the market has been conditioned to expect that. And when the market doesn't get it, it requires it. And that's the sense in which the markets are holding hostage the Fed, the ECB. In terms of how long this disconnect lasts, the reality is no one knows. What we do know is that it will take a major shock, either a policy mistake or a market accident. And what the market accident looks like is a capital impairment situation. It is wide-scale bankruptcies. The one thing that central banks cannot protect investors from is default risk. So that's what to look for. Be careful not to fall into the trap of defaults, because in that case, your mistake is non-recoverable.
So is this where you feel the central bank has gone wrong in the widespread ammunition that they really delivered? Because for the longest time, there was a complaint they weren't doing enough. And now it seems to be that they're just doing too much.
Look, I feel sorry for central banks because they have the flexibility to respond quickly, but they respond quickly on the assumption they'll be able to hand off the policy burden to somebody else. And the reality is that they've ended up carrying a heavier and heavier burden. My issue with what has happened recently, and I particularly disliked the Federal Reserve buying high-yield bonds, is that by going too far, you risk three things. One, you risk massive moral hazard. You are encouraging excessive risk-taking. And we have seen that not just on the investment side, but we have seen a record issuance of not just investment-grade bonds, but high-yield bonds at a time when everyone expects defaults to go up.
Sure.
But there's been a moral hazard element. So we have seen excessive risk taking, which I worry about. Secondly, in supporting markets in a way that is disconnected from fundamentals, you encourage not only zombie companies that eat away at the viability and dynamism of an economy, but also zombie markets that no longer price risk properly. And that's an issue for the longer term. And finally, you encourage a misallocation of resources. So I worry that what the markets are gaining now, which is real and incredibly satisfying, which is very high returns, comes at the cost of future lower returns and more financial volatility.
Okay, so there are a few economists who have a completely contrarian point of view, and they argue that this is perhaps too simplistic a take on what's currently happening. How would you respond to that? If we were to go a little deeper, how would you respond to the fact that there are serious concerns that you see currently?
So I think that the pushback against what I said comes really in two ways. One is well, the alternative would have been worse. Sure. That had central banks not stepped in and gone very far in both the scale of their involvement and the scope, that it would have been much worse. And I have some sympathy for this, but limited sympathy for this, because what central banks have inadvertently done is they've taken the burden off other policymakers. So yes, it would have been worse, but we're not sure how the other policymaking entities would have reacted. So that's the first type of. The second is much deeper, saying we've entered a new paradigm. We've entered a new paradigm in which debt doesn't matter, because inflation doesn't matter. And therefore, central banks should basically become an agent of the fiscal agency, and the fiscal agency should issue as much debt, and you should neutralize risk in the economy.
Right.
For me, that's fine if you had principles to do so. What I worry is we're going to come out with a spaghetti ball of central bank and government involvement in the private sector that's going to be very hard to sort out. And I worry that unless you have principles about how this massive involvement of central banks and governments in the private sector plays out, you may end up with such a spaghetti ball that the mess at the end does not warrant what you gain in the short term.
That doesn't sound like a very optimistic scenario at all. My concern then is, how do you see this impacting emerging markets, and particularly India, which currently is, of course, benefiting from fund flows, coming in. If we do see a shock to the system, as you describe, where do we stand?
So that is a problem, and emerging markets have been on the receiving end of the feast-famine tendency in the developed world. When it's a feast, tons of money comes in, including by what I call tourist investors that don't understand really what's going on in India. They just want to escape very low interest rates in their home markets. But like any tourist, the minute there's a bit of an issue, they tend to flee. So it is an issue for emerging markets. They have to realize that this massive cyclicality is a reality of engaging in the capital markets, and you have to act responsibly during the upside in order to have resilience on the downside.
Okay. All right. In light of what we are seeing with the markets at these record high levels, there is now also a sense of FOMO, at least in the current environment. No one's thinking of the shock to come. They're thinking about how to still get into this rally. Would you change strategy right now? Would you perhaps say, sure, perhaps reduce the cash pile, get in while you still can, or would you still remain cautious?
So, a lot depends on what else you're doing and what your circumstances are. So rather than tell you what others should do, let me tell you what I did. I entered, as you know, the downturn very, very cautious. I did go in after the March 23rd lows, but I went in a very qualified manner. And what I did is I looked for 4 characteristics. 1 is very strong balance sheet. 2 is positive cash flow. 3 is good management. And 4 are names that do well during the period of living with COVID and after that period.
Right.
So think of big tech as an example. Think of healthcare as an example. And initially, that was the absolute right call. Then we had a couple of weeks ago a handoff from these stay-at-home names, as they've become to be called, to the reopening names. And I missed on a big rally. But at that point, I exited the stay-at-home names because I felt that these valuations, the likelihood of making a mistake became quite high. Right. So over the last week or so, I've looked at this rally, and I've missed it. But I'm happy about that because I don't feel comfortable betting on 2 things. I don't feel comfortable betting on moral hazard. I never have in my life. I just don't like betting on being bailed out by somebody else. And I certainly don't feel comfortable about a V-shaped global economic recovery. And if you look at the IMF projection that just came out, they have actually gone more bearish about the global economy than they had just 2 months ago.
You know, I understand in terms of the implications you outlined of the policy moves, but in terms of the near-term recovery, so many indicators around the world seem to be suggesting it's going to be better than anticipated, while at the same time projections from the likes of the IMF indicate otherwise. It creates a lot of confusion as to what the reality really is.
Yeah, but the sequence is important. So when you have a lockdown and you come down very, very hard. And when we see the second quarter GDP numbers for the advanced world, they will shock us. They will be in the range of -25 to -30 falls in GDP. But when you fall this slow, the initial bounce back up is quite high. I mean, just think of if you are subject to a lockdown in your house and suddenly you're allowed to go out, you will go out. And therefore the delta looks very big. But then the subsequent phases of recovery become harder. So you can either think in terms of a square root sign, where you come down, you go back up quickly, and then you start flattening out. Or alternatively, think of a pendulum. We used to have a pendulum that was normal economic activity. We swung all the way to lockdown, which was a very radical swing. Now we're swinging back and we're going to oscillate, but we're not going all the way back. So the first swing back looks good, but then we start oscillating.
What is your opinion on what's really happening here in India from an economy and policy point of view? It's a country where we've been lauded for the initial reaction to trying to contain the pandemic. Today, we're one of the countries with the highest number of cases, but we have started to reopen the economy. Limited stimulus from a fiscal point of view. What do you think of it?
So let me just tell you, this is a very, very, very difficult environment. So I use 3 varies for any developing country. Because typically, you've gone through 3 phases. The first phase is one of importing the adverse spillover from what happened in China and from what happened in Europe and the United States. And it has been really bad. Lower exports, lower flows of foreign direct investment, lower workers' remittances, lower tourism, and a volatile market. That is a multi-hit that you've imported from the rest of the world. You haven't done anything yet. The second phase was COVID spreading in your own country, requiring relief measures, while you're also dealing with the shock from the outside. And then the third phase is trying to find the balance between lives and livelihoods, between health and the economy. And that is really difficult. That is 3 successive challenges without the previous one being eliminated. So I cannot underestimate what a difficult period this is for any developing country. India has done relatively well, but that's a relative statement. The absolute challenges are not just large, but they're generation defining. And everybody in society has to maintain focus, has to battle this adjustment fatigue. We've done enough now. When are the good days? Because you're dealing with cumulative shocks. So one has to be, households, companies, and governments must continue working together to navigate this very, very challenging period.
Do you feel the monetary stimulus was enough, or would you have expected to see fiscal stimulus, from a country the size of India? Perhaps they still will announce some, but do you feel that should have been the need of the hour?
So India avoided the mistake that other countries have done, which is to assume, and I'm going to use a term from game theory, which is a really good tool that economists use. And I want to stress, this is not a game. This is very, very serious. But game theory provides real insights as to what is the right reaction function. So there's the notion in game theory of a one-round game and a multi-round game. One shot and multiple shots. And how you approach these in terms of resilience differs. So if you believe this is a one big shock, you go all in. You do whatever it takes. You throw everything at it. If, however, it's a multi-round shock, you've got to be much more careful, much more measured. You've got to make difficult decisions between how much of your resilience you use now and how much of your resilience you keep for tomorrow. So I am less critical than others when a government and the central bank doesn't go all in, because I believe, unfortunately, that this is a multi-round situation, that living with COVID is going to be hard. We're going to continue swinging in this pendulum between better economy, worse health, better economy, worse health. And you've got to keep resilience to navigate through these oscillations.
Okay, layer onto that the tensions with China, whether it be US-China, whether it be India-China. How serious do you feel is the threat to deglobalization, just to changing dynamics, whether it be trade, whether it be geopolitical?
Yeah, and you're making me sort of focus on all the risks and the downside risks, and I hope we'll have time to focus on the upside risks too, because I do believe there's an upside there. But it's a very complicating factor, and it's one that markets have unfortunately ignored. Look, we have entered a period of deglobalization, and that is not good for markets, and that is not good for global economic growth. And unlike the previous two shocks to globalization in the last 10 years, this one will involve, unfortunately, every element of society, especially in the advanced world. So if you remember, the first shock to globalization was back in 2010.